Picture this, a group of economists sitting around a table in Washington deciding whether your mortgage payment goes up, whether your savings account earns anything meaningful, and whether your neighbor keeps their job. Sounds like a conspiracy theory, right? Except it's just the Federal Reserve doing what it does every 6 weeks. Most people have heard of the Fed. Plenty of people have opinions about the Fed, but almost nobody actually understands what the Fed does or how it does it. And honestly, that's kind of by design. They don't exactly make it easy. So let's fix that. We're going to break down what the Federal Reserve actually is, what tools it uses to mess with the economy, and why you should care even if economics makes your eyes glaze over. First thing you need to know, the Federal Reserve isn't actually part of the federal government. Not really. It's this weird hybrid creature. Part public, part private. Congress created it back in 1913 after a series of banking panics made everyone realize that maybe we needed someone to keep an eye on things. But it operates independently, which means the president can't just call them up and say, "Hey, make my economy look good before the election." Here's the thing. The Fed has one main job, and that's controlling the money supply to keep the economy stable. They do this primarily by setting interest rates. When you hear that the Fed raised rates, what they're actually doing is adjusting the federal funds rate. That's the rate banks charge each other for overnight loans. Sounds boring, but this one number ripples through the entire economy. Think of it like this. When the Fed raises rates, borrowing money gets more expensive for everyone. Your credit card rate goes up. Your car loan costs more. Businesses think twice about expanding. The economy slows down. When they lower rates, borrowing gets cheaper. People spend more. Businesses hire. The economy heats up. The Fed is constantly trying to find that Goldilocks zone where the economy is growing, but not so fast that prices spiral out of control. And that brings us to inflation, which is the thing the Fed obsesses over. Their official target is 2% inflation per year, not 0, which surprises people. A little inflation is actually healthy because it keeps money moving. If prices are falling, you'll just wait to buy stuff because it'll be cheaper tomorrow. That kills economic activity fast. The move, understanding that the Fed is always trying to balance two things: maximum employment and stable prices. These goals often conflict. When unemployment is super low and everyone has jobs, wages go up, spending increases, and inflation can get out of hand. So the Fed raises rates to cool things off, which can cost people jobs. It's a brutal trade-off, and there's no perfect answer. Now let's talk about the tools they actually use. Interest rates are the big one, but they've got others. Quantitative easing is when the Fed literally creates money and uses it to buy bonds and other assets. They did this massively during the 2008 financial crisis and again during COVID. It pumps money into the system and keeps credit flowing when everything's frozen up. They also set reserve requirements, which is how much cash banks have to keep on hand instead of lending out. Lower requirements mean banks can lend more. Higher requirements mean they lend less. Simple concept, massive impact. Here's what matters for you. Every Fed decision affects your financial life. When they raise rates, it's a good time to shop around for better savings account yields because banks are finally paying something. It's also a signal to maybe hold off on that big purchase you were planning to finance. When they cut rates, it's refinancing season for your mortgage, but your savings are going to earn basically nothing. The practical move is to pay attention to Fed meetings. They happen 8 times a year, and the news covers them. You don't need to understand every detail, but knowing which direction rates are heading helps you make smarter money decisions. One more thing, the Fed chair, currently Jerome Powell, has arguably more influence over your day-to-day finances than the president does. When the chair speaks, markets move. So yeah, maybe worth knowing who that person is. If you want more breakdowns of economic stuff that actually affects your life, hit subscribe and let me know in the comments what financial topic confuses you most.